Hello and welcome to your ultimate guide for the California Life and Health Examination. My goal today is simple: give you everything you need to fully understand the key concepts, master them, and walk into your exam with total confidence. In this video we'll cover agency law, trust accounts, property ownership, real estate contracts, fair housing. With over 100 plus success stories, we have proven our videos will help you pass your exam on the first attempt. And remember, our website offers free exam guides and practice questions to help you ace your exam. You'll find the link in the description below, so be sure to check it out and get the resources you need to study smarter, not harder. So let's get started.
Question 1. A rider that pays an extra benefit, often doubling the face amount, when the insured dies as a result of an accident, is commonly known by which name? Your options are A. Waiver of premium, B. Guaranteed insurability, C. Cost of living rider, D. Double indemnity. Which one is it? Pause the video if you need more time. The correct answer is D. Double indemnity. D is correct because the accidental death benefit rider pays an additional amount when death results from an accident, and because it can double the face amount, it is popularly called double indemnity. A is wrong because waiver of premium keeps a policy in force without premiums during disability. It does not add an accidental death benefit. B is wrong because guaranteed insurability lets the insured buy more coverage later without proving insurability, which is unrelated to accidental death. C is wrong because a cost of living rider adjusts benefits for inflation, not an extra payout triggered by an accidental death. The accidental death benefit rider is an add-on to a life insurance policy that pays an extra sum when the insured dies directly as the result of an accident. Understanding how it works and how it differs from similar riders is essential for the exam. The rider is triggered only by accidental death, not illness or disability. Most contracts require the death occur within 90 days of the accident and before a stated age. The benefit is paid on top of the regular death proceeds to the named beneficiary. Because the extra amount is so often set equal to the face amount, the total payout doubles, which is exactly why this provision earned the nickname double indemnity. The rider adds nothing for natural causes, only the manner of death flips the switch. Consider a whole life policy with a $200,000 face amount and a matching accidental death benefit rider. A highway collision triggers both. The beneficiary receives $400,000 total. Death from heart disease pays only the base $200,000. The rider contributes nothing. 4 riders often appear together on exams. Waiver of premium keeps coverage active while the insured is disabled. Guaranteed insurability lets the insured buy more coverage later without proving health. A cost of living rider raises the benefit over time. Only the accidental death benefit ties an extra payout to the cause of death. That link is exactly what double indemnity names. Question 2. Under the California Insurance Code, the Accident and Health or Sickness Agent license authorizes the licensee to transact coverage for which of the following? Your options are A. Real and personal property, B. Automobile liability, C. Sickness, bodily injury, or accidental death, D. Workers' compensation only. Take a second, and which answer would you pick? The correct answer is C. Sickness, bodily injury, or accidental death. C is correct because the Accident and Health or Sickness license authorizes coverage for sickness, bodily injury, or accidental death, and may include disability income benefits. It does not extend to property or casualty lines. A is wrong because real and personal property coverage falls under a property license, not the Accident and Health license, which is built around sickness and injury. B is wrong because automobile liability is a casualty line requiring a separate license. The accident and health agent has no authority to transact it. D is wrong because the license is not limited to workers' compensation. It broadly covers sickness, bodily injury, and accidental death for individuals. In California, a producer's license is tied to a specific line of authority, the category of insurance they're qualified to sell. The accident and health or sickness license is one such line, and understanding exactly what it covers and what it doesn't is the core concept here. The accident and health or sickness license authorizes a producer to transact coverage for sickness, bodily injury, and accidental death. That umbrella includes disability income, medical expense plans, long-term care, and Medicare supplement, all built on health-related perils. The state draws a hard line between two sides. On the health side sit disability income, long-term care, and Medicare supplement. On the property and casualty side sit auto liability, workers' compensation, and dwelling coverage. Workers' comp pays for workplace injuries, but it is a casualty product, not part of the health license. Picture two columns separated by a firm boundary. The accident and health license is the key to the left column only. A producer who wants access to property and casualty products must earn a separate key by qualifying through a completely different examination. California requires separate licensing for each line because the knowledge behind health products and property casualty products is almost entirely different. Consumer protection depends on producers being trained and examined on exactly what they sell. Nothing more, nothing less. Question 3. When a consumer applies through Covered California, which entity verifies income and calculates the amount of any premium subsidy? Your options are A. The consumer's employer, B. The insurance producer alone, C. The county tax assessor, D. Covered California, the exchange. Before I reveal it, which one do you think is right? The correct answer is D. Covered California, the exchange. D is correct because Covered California, as the exchange, verifies the applicant's identity and income against federal poverty level data and calculates the amount of any subsidy, which it then applies directly to the chosen plan. A is wrong because the employer does not calculate an individual marketplace subsidy. The exchange performs that determination. B is wrong because the producer assists the consumer but does not calculate the subsidy, which Covered California determines. C is wrong because the county tax assessor handles property assessment, not eligibility for marketplace premium subsidies. Covered California is the state's official health insurance marketplace, but its most important function isn't just letting people shop for plans. Its defining role is determination, verifying who qualifies for financial help and calculating exactly how much. Three roles must stay distinct. The exchange determines eligibility and calculates the subsidy amount. The insurer issues the selected plan and receives the subsidy payment. The producer advises the applicant and helps complete the application, but never computes the subsidy. When an applicant applies, the exchange checks their income against federal data sources, measures it against the federal poverty guidelines, and then calculates the advanced premium tax credit and any cost-sharing reductions. That calculated credit is then applied directly to the plan the consumer chooses. Common distractors on exam questions include the insurance producer, the consumer's employer, the county tax assessor, and the insurer. None of these parties calculate the subsidy. Only the exchange performs that determination. Whenever a question describes the machinery that decides how large a subsidy is, words like verifies income or calculates the credit, kaiti and turiti. Those signal words point to one answer, the exchange itself. Question 4. In a disability income policy, the elimination period functions as which of the following? Your options are A. A time deductible before benefits begin. B. A cash deductible per claim. C. The maximum benefit period. D. A refund of premiums. What's your answer? Commit to one before I continue. The correct answer is A. A time deductible before benefits begin. A is correct because the elimination period is a time deductible. The insured must remain disabled for a stated number of days before benefits begin. Benefits are not paid retroactively for that waiting period. B is wrong because the elimination period is measured in time, not dollars, so it is not a cash deductible. C is wrong because the maximum length benefits are paid is the benefit period, not the elimination period. D is wrong because the elimination period is a waiting period, not a refund of premiums to the insured. Once a disability income claim is filed, benefits don't start immediately. There's a built-in waiting period called the elimination period, and understanding exactly what it does and what it isn't is the key to reading a disability policy correctly. Think of the elimination period as a time deductible. A dollar deductible makes you absorb the first portion of a loss in money. The elimination period makes you absorb the first portion of a disability in time. No benefits are paid during that opening stretch, and those days are never paid back retroactively. There are three distinct concepts to keep apart. The cash deductible is money the insured pays before coverage responds. The elimination period is time the insured waits before benefits begin. The benefit period is the span over which benefits are actually paid once they start. Here's how the structure plays out on a real claim. The elimination period sits at the front. The insured self-insures those first days using savings or sick leave. Only after that period is fully satisfied do monthly benefits begin, and they can continue for the full length of the benefit period. The elimination period exists to keep coverage affordable. Most disabilities are short-lived, and paying every brief claim from day one would flood insurers with small, costly-to-administer losses. By requiring the insured to wait, amutati marketinam in make sold, typically 30, 60, 90 days or more, the insurer cuts costs, and those savings translate directly into a lower premium. Question 5. Compared with a flexible spending arrangement, a health savings account differs because the health savings account does which of the following? Your options are A. Forfeits unused funds each year. B. Is owned by the employer. C. Is individually owned and rolls over. D. Requires no health plan at all. Pick one. Trust your gut. Here's your chance to taste yourself. The correct answer is C. Is individually owned and rolls over. C is correct because a health savings account is individually owned and fully portable, and unused funds roll over and accumulate year to year. A flexible spending arrangement, by contrast, generally forfeits unused funds. A is wrong because forfeiting unused funds each year describes the flexible spending arrangement, not the health savings account, which rolls funds over. B is wrong because a health savings account is owned by the individual, not the employer, which is part of why it is portable between jobs. D is wrong because a health savings account requires a qualifying high deductible health plan, so it is wrong to say it needs no health plan. Health savings accounts and flexible spending arrangements both let you set aside pre-tax dollars for medical costs, but they work in fundamentally different ways. Understanding what makes each one distinct is what examiners are really testing. The HSA belongs to the individual, not the employer, so it travels with you when you change jobs. Unused funds roll over and keep accumulating year after year. The FSA is established through your employer's plan, and money not spent by the deadline is generally forfeited. with only a limited carryover allowed at the employer's option. One critical requirement: an HSA is not a standalone product. It is valid only when the account holder is enrolled in a qualifying high-deductible health plan. The high-deductible plan carries lower premiums but high out-of-pocket costs, and the RTSA was specifically created to help cover those early expenses with tax-favored dollars. When a question asks how an HSA differs from an FSA, anchor your answer to ownership and rollover. The HSA is individually owned and rolls the balance forward. The FSA is tied to the employer's plan and forfeits what is not used. Those two contrasts are the whole comparison. Question 6. A health plan that is certified by and sold on the exchange covers the essential health benefits and is the only plan that can carry subsidies is known as which of the following? Your options are A, grandfathered plan, B, an accepted benefit plan, C, a self-funded plan, D, a qualified health plan. Which would you go with? Lock it in before the reveal. The correct answer is D, a qualified health plan. D is correct because a qualified health plan is certified by and sold on the exchange, covers the essential health benefits, follows cost-sharing limits, and is the only kind of plan eligible for premium tax credits and cost-sharing reductions. A is wrong because a grandfathered plan predates the reforms and is not an exchange-certified plan carrying subsidies. B is wrong because an accepted benefit plan, such as standalone dental, is not comprehensive coverage and does not carry marketplace subsidies. C is wrong because a self-funded plan is an employer arrangement governed by federal law, not an exchange-certified qualified health plan. A qualified health plan is a specific kind of coverage certified by the Health Insurance Exchange to be sold on the marketplace. That certification is what separates it from other types of plans, and it carries important financial consequences. To earn certification, a plan must clear 3 hurdles. It must cover the essential health benefits, comply with federal cost-sharing and consumer protection rules, and satisfy the exchange's own standards for every plan it lists. Qualified plans are sorted into 4 metal tiers: bronze, silver, gold, and platinum, describing how costs are split between the plan and the enrollee. The advanced premium tax credit can attach to any qualified plan, but cost-sharing reductions attach exclusively to silver tier qualified plans for eligible households. 4 plan types fall outside the qualified category and cannot carry marketplace subsidies. Grandfathered plans predate reform and operate under older rules. Accepted benefit plans like standalone dental or fixed indemnity products are not comprehensive. Self-funded employer plans are governed by federal benefits law, not exchange certification. The simplest way to keep these straight: ask whether a plan is certified by the exchange and provides comprehensive coverage. If both answers are yes, it is a qualified health plan and eligible for subsidies. If either answer is no, subsidies cannot attach. Question 7. Under the Family and Medical Leave Act, an eligible employee of a covered employer may take up to 12 weeks of leave, during which the employer must do which of the following? Your options are A. Maintain the employee's group health coverage, B. Pay the employee full wages, C. Terminate the group coverage, D. Convert the plan to an individual policy. Don't overthink it. Which one feels right? The correct answer is A. Maintain the employee's group health coverage. A is correct because during Family and Medical Leave Act leave, the employer must maintain the employee's group health coverage on the same terms as if the employee were working. The leave itself is unpaid and job protected. B is wrong because the leave is unpaid, so the employer is not required to pay full wages during Family and Medical Leave Act leave. C is wrong because the law requires the employer to keep coverage in force, not terminate it while the employee is on protected leave. D is wrong because the employer maintains the existing group coverage during leave rather than converting the plan to an individual policy. The Family and Medical Leave Act is a federal law that protects both your job and your health coverage when life demands you step away from work. Understanding exactly what employers must and must not do during that leave is the key to mastering this topic. FMLA guarantees 3 things. Your job is protected. Your group health coverage continues on the same terms as if you never left. And, critically, the leave is unpaid. The employer must keep the health plan running, but is not required to keep issuing paychecks. The employer's duty is continuity of the existing group plan. The premium split stays the same, and the employer cannot push the worker off the group plan onto an individual policy. What stops is the paycheck. Income replacement is simply not part of FMLA. It helps to contrast FMLA with continuation coverage. Under FMLA, the worker stays an active member of the group plan throughout the leave. Continuation coverage kicks in only after a qualifying event ends that active membership. Like Chuatin Iti, it extends coverage after it would otherwise stop, not during a protected absence. When an exam stem asks what an employer must do for health coverage during FMLA leave, the answer is always to keep the existing group plan in force on the same terms, and said, not to replace income and not to convert the employee to any other plan. Question 8. Charging all subscribers of a plan the same rate structure, regardless of any single group's loss history, is known as which rating method? Your options are A. Experience rating, B. Retrospective rating, C. Community rating, D. Schedule rating. Got a guess? Lock it in. The correct answer is C. Community rating. C is correct because community rating applies the same rate structure to all subscribers, ignoring any one group's past loss experience. It is used in the individual market and for small groups too small to be credibly experience rated. A is wrong because experience rating bases the premium on a particular group's own claims history, which is the opposite of a common community rate. B is wrong because retrospective rating adjusts a premium after the period based on actual losses, not a single fixed rate for the whole community. D is wrong because schedule rating adjusts premium for specific risk characteristics rather than charging every subscriber the same rate. Community rating is a method of pricing health insurance where every subscriber in a defined community pays according to the same rate structure, regardless of their personal health history. The premium is built on the expected costs of the entire pool, not on any one buyer's record. In its purest form, a healthy applicant and a less healthy one in the same category pay on the same basis. Modern reform allows only a narrow set of adjustment factors: age within limits, geographic area, family size, and tobacco use, but never a surcharge based on health status or claims history. Think of community rating as pooling everyone together so that unpredictable swings from any one buyer are absorbed by the larger group. Experience rating does the opposite. It sets a group's premium from that group's own prior claims, rewarding good experience and penalizing bad. It helps to keep all 4 rating methods distinct. Community rating builds on the pool and ignores the individual's history. Experience rating builds on the group's own past claims. Retrospective rating adjusts the premium after the coverage period ends, and schedule rating tweaks premiums for specific named risk characteristics. Whenever an exam stem describes a single shared rate applied to all subscribers regardless of any one group's loss history, that is community rating. Ask what the premium is built on. If the answer is the community pool, not the buyer's own record, community rating is the answer. Question 9. How is the advance premium tax credit typically delivered for a marketplace enrollee? Your options are A. Paid in advance directly to the insurer. B. As a year-end refund check. C. Deposited into a health savings account. D. Paid to the enrollee's employer. Which one is it? Pause the video if you need more time. The correct answer is A. Paid in advance directly to the insurer. A is correct because the advance premium tax credit is paid in advance, each month, directly to the insurer to reduce the enrollee's premium, rather than waiting until the enrollee files a tax return at year end. B is wrong because the credit is advanced monthly to the insurer rather than held until a year-end refund, though it is reconciled at tax time. C is wrong because the credit is applied to the premium through the insurer, not deposited into a health savings account. D is wrong because for an individual marketplace plan, the credit goes to the insurer, not to the enrollee's employer. The advance premium tax credit is how the marketplace lowers your monthly health plan cost, and the key word is advance. Instead of waiting until tax season, the help arrives right when you need it. Each month, the exchange sends the credit directly to your insurer, not to you. The insurer applies it immediately, so your premium bill arrives already reduced and you only pay the difference out of pocket. The money never passes through the enrollee's hands. The exchange pays the insurer directly each month, and the enrollee sees only the reduced net premium on their bill. It helps to know what the advance credit is not. It is not a year-end refund, not deposited into an HSA, not paid to an employer, and not a cost-sharing reduction, those lower deductibles and co-pays, while this credit specifically shrinks the monthly premium. At tax time, actual income is compared to the estimate and the credit is reconciled, vice, but the help itself was already delivered, month by month, all year long. Question 10. While an insured remains disabled, the provision that keeps a disability income policy in force without further premium payments is known as which of the following? Your options are A. Cost of living adjustment. B. Guaranteed insurability. C. Recurrent disability. D. Waiver of premium. Take a second. Which answer would you pick? The correct answer is D. Waiver of premium. D is correct because waiver of premium keeps the policy in force without further premiums while the insured is disabled after the waiting period is satisfied. Premiums paid during the waiting period are typically refunded once benefits begin. A is wrong because a cost of living adjustment increases a benefit in payment for inflation, not the waiving of premiums. B is wrong because guaranteed insurability lets the insured buy more coverage later, not avoid premiums during disability. C is wrong because a recurrent disability provision addresses a relapse from the same cause, not the waiving of premiums. The waiver of premium provision keeps a policy in force during total disability, no premium payments required. It exists because a disabling injury often cuts off income at exactly the moment a household can least afford to lose coverage. The sequence is straightforward. The insured becomes disabled and must survive a waiting period, often around 6 months. Once that period is met, premiums are waived and many contracts refund premiums paid during the wait. When the insured recovers, the duty to pay simply resumes. Examiners love to test which rider does what. Waiver of premium excuses premiums during disability. A cost of living adjustment grows the benefit against inflation. Guaranteed insurability secures the right to buy more coverage. Recurrent disability decides whether a relapse counts as the same claim or a new one. The signal phrase to watch for is coverage continuing without premiums while the insured remains disabled. That is always waiver of premium. Nothing else keeps the policy alive simply by excusing the bill. Question 11. Coinsurance differs from a co-payment because coinsurance is calculated as which of the following? Your options are a flat dollar amount per service, B, a fixed monthly premium, C, a percentage of covered expenses, D, the annual deductible amount. Before I reveal it, which one do you think is right? The correct answer is C, a percentage of covered expenses. C is correct because coinsurance is a percentage of covered expenses the insured shares after the deductible, while a co-payment is a flat dollar amount for a service. The percentage versus flat dollar contrast is the key difference. A is wrong because a flat dollar amount per service describes a co-payment. The very term coinsurance is being distinguished from here. B is wrong because a fixed monthly premium is the cost of keeping the policy in force, not the cost-sharing percentage applied to a claim. D is wrong because the annual deductible is paid before coverage begins, not the percentage shared with the insurer after the deductible. Cost-sharing is how insurers keep you financially connected to the care you use. Two of the most tested forms are coinsurance and the co-payment. And the key difference comes down to one question: percentage or flat dollar. There are 4 cost-sharing terms that appear together on exams. The deductible is paid first, before coverage kicks in at all. Coinsurance and the co-payment both apply during coverage, but they work differently, and the premium is simply the standing cost of holding the policy. After the deductible is satisfied, covered expenses are split by the coinsurance percentage, commonly 80% paid by the plan and 20% by you. This continues until you reach the annual out-of-pocket maximum, after which the plan covers the remainder in full. Take a $10,000 hospital bill under an 80-20 plan. Coinsurance makes the insured responsible for $2,000 because the share is a percentage that scales with the bill. A co-payment for a routine office visit that same week is a fixed figure. It does not move no matter what the underlying visit costs. When an exam stem describes a percentage of covered expenses after the deductible, that is coinsurance. When it describes a fixed dollar charge per visit, that is a co-payment. Keep those two definitions crisp and the distractors, deductible and premium, and fall away on their own. Question 12. Compared with a tax-qualified long-term care policy, a non-tax qualified policy generally differs in which way? Your options are A. Taxable benefits and non-deductible premiums. B. Its benefits are always tax-free. C. It must meet stricter federal standards. D. It cannot be sold in California. What's your answer? Commit to one before I continue. The correct answer is A. Taxable benefits and non-deductible premiums. A is correct because a non-tax qualified policy may have taxable benefits and non-deductible premiums, the trade-off for more flexible benefit design. A tax-qualified policy offers tax-free benefits and possible premium deductions but must meet federal standards. B is wrong because non-qualified benefits may be taxable, so they are not always tax-free like qualified benefits. C is wrong because non-qualified policies do not have to meet the federal qualification standards. Qualified policies do. D is wrong because non-qualified policies may still be sold. Federal law does not prohibit them. Long-term care policies fall into 2 categories under federal law: tax-qualified and non-tax qualified. Understanding what each category trades away helps you see why the distinction matters. A tax-qualified policy rewards the policyholder with 2 tax advantages. Benefits received are generally free of federal income tax, and premiums may count toward deductible medical expenses. A non-qualified policy gives up both of those guarantees. The difference in rules centers on benefit triggers. A tax-qualified policy requires a licensed health practitioner to certify inability to perform at least 2 of the 6 activities of daily living for 90 days or more. or the presence of severe cognitive impairment. A non-qualified policy can use a medical necessity standard, allowing benefits to begin sooner. Think of it as a deliberate trade-off built into federal law. The tax-qualified policy optimizes for tax treatment but must satisfy strict federal standards. The non-qualified policy optimizes for flexibility in benefit design, accepting the loss of guaranteed tax advantages as the price. The clean way to hold these apart: tax advantages are bundled with stricter rules. A non-qualified policy is perfectly legal to sell. It simply cannot promise the same tax treatment in exchange for its freer benefit design. Question 13. Which of the following is the distinguishing emphasis of a health maintenance organization compared with traditional insurance? Your options are: A. Unlimited choice of any provider. B. Payment of fixed daily hospital income. C. Coverage only for named diseases. D. Preventive care to detect conditions early. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is D. Preventive care to detect conditions early. D is correct because an HMO emphasizes preventive care, such as routine physicals, immunizations, and screenings, to detect conditions early and reduce the need for costly treatment later. A is wrong because unlimited provider choice describes a traditional indemnity plan. HMO members must generally use the plan's own network. B is wrong because fixed daily hospital income is a feature of a limited hospital indemnity policy, not the preventive focus of an HMO. C is wrong because coverage limited to named diseases describes a dread disease policy, not the broad preventive care an HMO provides. A health maintenance organization, or HMO, is a managed care model built around one core idea: keeping members healthy in the first place. Understanding why it emphasizes prevention requires looking at how it's designed and financed. Members choose a primary care physician who acts as a gatekeeper, coordinating all care and authorizing referrals to specialists. Preventive services like physicals, immunizations, and screenings are built into the model and covered at little or no cost. HMOs are often paid a fixed amount per member per month, called capitation. This flips the usual incentive. When the organization keeps members healthy and out of the hospital, it retains more of that fixed payment. Prevention becomes a financial strategy, not just a benefit. The key exam skill is telling these plans apart. An indemnity plan finances care with free provider choice. A hospital indemnity policy pays a flat daily benefit. A dread disease policy covers only listed conditions. Only the HMO is organized around managing care and pushing prevention. When a question highlights early detection, wellness visits, and routine screenings as a plan's defining focus, that's your signal. It's describing an HMO, the model built to catch problems early before they become costly. Question 14. Under the California Insurance Code, the neglect to communicate something that a party knows and ought to communicate is defined as which of the following? Your options are: A. Warranty, B. Estoppel, C. Concealment, D. Subrogation. Which would you go with? Lock it in before the reveal. The correct answer is C. Concealment. C is correct because the California Insurance Code defines concealment as the neglect to communicate that which a party knows and ought to communicate. Concealment is a failure to disclose, not a false statement. A is wrong because a warranty is a statement guaranteed to be true and made part of the contract, which is the opposite of a silent failure to disclose. B is wrong because estoppel bars a party from contradicting its earlier conduct, a doctrine unrelated to the failure to communicate a known material fact. D is wrong because subrogation lets an insurer recover from a responsible third party after paying a claim, which has nothing to do with non-disclosure. Concealment under California Insurance Code is not about lying, it's about staying silent. When an applicant knows a material fact and simply doesn't mention it, that omission itself is what the law calls concealment. Insurance is a contract of utmost good faith, because insurers rely entirely on applicants to disclose what they know. Hiding a material fact, even in total silence, undermines the fairness of the whole transaction and gives the insurer grounds to void the policy. Concealment is easily confused with other insurance terms. A warranty is an affirmed, guaranteed statement written into the contract, the opposite of silence. Subrogation lets an insurer recover from a responsible third party after paying a claim. Neither describes quiet withholding. The doctrine turns on two conditions. The applicant must have actually known the fact, and the fact must be material, meaning it would influence a reasonable insurer's decision. When both are present, the insurer may void the policy regardless of whether any false word was ever spoken. When an exam stem describes an applicant who simply says nothing about something they knew and should have disclosed, the concept is concealment. The key signal, neglect to communicate a known material fact. Question 15. Under California law, a Medigap policy must be at least guaranteed renewable, which means the insurer may not cancel it for which reason. Your options are A. The insured's declining health status. B. Non-payment of premium. C. Material misrepresentation on the application. D. The insured moving out of state. Don't overthink it. Which one feels right? The correct answer is A. The insured's declining health status. A is correct because a Medigap policy must be at least guaranteed renewable, so the insurer cannot cancel or non-renew it because of the insured's health status. Cancellation is allowed only for non-payment or material misrepresentation. B is wrong because non-payment of premium is a permitted reason to end coverage, so it is not a prohibited basis for cancellation. C is wrong because material misrepresentation, shown within the 2-year contestability period, is a permitted basis to rescind, not a prohibited one. D is wrong because the protection bars cancellation for health status. The question asks for that prohibited reason, which is declining health. Medicare supplement policies in California must be at least guaranteed renewable. This means the insurer is obligated to renew the policy and cannot cancel or refuse renewal simply because the insured's health has declined, protecting the coverage precisely when it matters most. The guarantee exists because Medigap buyers are older and grow less healthy over time. A policy that could be dropped the moment someone developed a serious condition would fail at the one job it was purchased to do. Insurers are limited to a narrow set of permitted reasons for ending coverage. Non-payment of premium, material misrepresentation during the contestability period, and class-wide premium increases are all allowed. Declining health status, however, is strictly forbidden as a basis for cancellation or non-renewal. Material misrepresentation on the application is a permitted ground, but only during the contestability period, generally the first 2 years. Once that window closes, the insurer loses that basis. Non-payment remains valid at any time, but a policyholder who pays and told the truth at application keeps coverage no matter how sick they become. The key divide is simple. Declining health belongs in the forbidden pile, while non-payment of premium and material misrepresentation belong in the allowed pile. That split is the entire point of guaranteed renewability under California law. Question 16. To carry the partnership asset protection benefit, California partnership long-term care policies are required to include which feature? Your options are A cash surrender value, B, a prior hospital stay requirement, C, coverage limited to 1 year, D. Automatic inflation protection. Got a guess? Lock it in. The correct answer is D. Automatic inflation protection. D is correct because California partnership policies must include automatic inflation protection so that benefits keep pace with the rising cost of care. The program is operated by the state, private insurers, and the Medicare agency. A is wrong because a cash surrender value is not a required partnership feature, and tax-qualified policies generally have none. B is wrong because long-term care policies, including partnership policies, cannot require a prior hospital stay. C is wrong because partnership policies are not limited to 1 year. Long-term care must cover at least 12 months. The California Partnership for Long-Term Care is a joint program between the state, private insurers, and Medicare, designed to encourage people to cover their own long-term care needs privately, easing the burden on public assistance. Here is the core incentive. For every dollar a partnership policy pays in benefits, the insured can shield an equal dollar of personal assets from Medicare's spend-down rules. This dollar-for-dollar match only holds up if the policy's benefits stay meaningful over time. That is why automatic inflation protection is the one non-negotiable requirement. Benefits must grow automatically so that decades later, when care costs have climbed sharply, the coverage still has real value, and the asset protection promise still holds. The exam tests whether you can separate what is mandatory from what is not. A cash surrender value is unrelated. A prior hospital stay requirement is actually prohibited. Coverage cannot be conditioned on hospitalization, and a 1-year cap falls below the 12-month minimum every long-term care policy must meet. When a question asks what a partnership policy must include, anchor on purpose. Asset protection only works if benefits keep their value. Automatic inflation protection is the required feature. Everything else is either unrelated, forbidden, or below the legal floor. Question 17. Under California law, a group health policy that covers spouses must provide coverage to a registered domestic partner in what manner? Your options are: at a higher premium than spouses, B, equal to a spouse's coverage, C, only after a waiting period, D, only for same-sex partners. Which one is it? Pause the video if you need more time. The correct answer is B, equal to a spouse's coverage. B is correct because California requires a group health policy covering spouses to provide equal coverage to a registered domestic partner on the same terms and conditions, and prohibits discrimination between same-sex and opposite-sex couples. A is wrong because charging a domestic partner a higher premium would be unequal coverage, which the statute specifically forbids. C is wrong because the law requires equal terms and conditions, not a special waiting period applied only to domestic partners. D is wrong because coverage may not discriminate between same-sex and opposite-sex partners, so limiting it to same-sex partners is incorrect. California law requires that any group health plan covering spouses must also cover registered domestic partners, (MAGSUT), and not just nominally. The coverage must be identical in every respect. The rule of equal terms means the plan must enroll a registered domestic partner on identical footing to a spouse. The same premium, the same benefits, the same eligibility conditions, and the same waiting periods. No slower or costlier path is permitted. Visually, the relationship is a mirror. Whatever the plan provides to a spouse flows identically to the registered domestic partner. The statute treats the domestic partnership as the equal of marriage for group health coverage purposes. Plans are specifically forbidden from charging domestic partners a higher premium, imposing a special waiting period, limiting coverage to same-sex couples only, or offering a reduced benefits tier. Each of these breaks the parity the statute demands. The clean way to remember California's rule, equality is the entirety of it. A domestic partner stands in the shoes of a spouse, and the plan owes that partner the same coverage on the same terms. No exceptions. Question 18. The Medigap open enrollment period is a 6-month window that begins when a person is 65 and enrolled in which of the following? Your options are A. Medicare Part A only, B. A Medicare Advantage plan, C. Medicare Part B, D. Medicaid. Take a second. Which answer would you pick? The correct answer is C. Medicare Part B. C is correct because the Medigap open enrollment period is a 6-month window beginning the first month a person is both age 65 or older and enrolled in Medicare Part B. During it, Medigap is guaranteed issue without health underwriting. A is wrong because the window is keyed to Part B enrollment, not Part A alone, since Medigap supplements both parts of original Medicare. B is wrong because enrolling in a Medicare Advantage plan does not start the Medigap open enrollment window, which depends on Part B. D is wrong because Medicaid enrollment does not trigger Medigap open enrollment. The trigger is being 65 and enrolled in Part B. When someone first becomes eligible for Medicare, they get one protected window to buy a Medigap supplement policy. Understanding exactly what starts that clock and what doesn't is the core idea here. During the 6-month window, the supplement is guaranteed issue. That means the insurer cannot deny coverage, cannot charge more, and cannot impose a longer wait for pre-existing conditions, regardless of how sick the applicant is. The window opens the first month a person is both age 65 or older and enrolled in Medicare Part B. Neither condition alone is enough. It takes both at the same time. Examiners often test the precise trigger. Part A alone does not start it. Joining a Medicare Advantage plan does not start it. Medicaid enrollment does not start it. Only the combination of age 65 and Part B enrollment opens the guaranteed issue window. Once the 6 months pass, insurers may return to medical underwriting. So the rule gives every new beneficiary exactly one clean underwriting free shot, tied to Part B enrollment and age 65 together. Question 19. Medigap policies are federally standardized. What does that mean for a given lettered plan? Your options are A. Its benefits are the same everywhere. B. Its price is fixed by the government. C. It is sold by only one company. D. Its benefits change every year. Before I reveal it, which one do you think is right? The correct answer is A. Its benefits are the same everywhere. A is correct because federally standardized means a Medigap plan with a given letter offers exactly the same benefits no matter which insurer sells it. Companies compete on price and service, not on the benefits of a lettered plan. B is wrong because standardization fixes the benefits, not the price. Insurers set and compete on premiums. C is wrong because a lettered plan may be sold by many companies. Standardization concerns the benefits, not the number of sellers. D is wrong because the standardized benefits of a lettered plan do not change from year to year based on the insurer. Medigap supplement plans are federally standardized, which means the letter on the plan determines the benefits, not the company selling it. Understanding what standardization locks in and what it leaves open is the core of this concept. No matter which insurer you buy from, Plan G is Plan G. The benefit package is defined by federal rule, so every company selling that letter delivers exactly the same coverage. Standardization fixes benefits. They are identical across all sellers of the same lettered plan. What insurers remain free to compete on is the premium they charge and their service quality and financial strength. Standardization does not mean only one insurer offers a plan, and it does not mean benefits change depending on who sells it that year. Many companies can sell the same letter, and the federal standard, not each insurer, defines the benefit package permanently. When comparing the same lettered Medigap plan across insurers, focus on premium, service, and financial stability because the benefits are already guaranteed to be identical. Question 20. An insurer organized under the laws of a country other than the United States and doing business in California is classified as which of the following? Your options are A. A domestic insurer, B. A foreign insurer, C. A fraternal insurer, D. An alien insurer. What's your answer? Commit to one before I continue. The correct answer is D. An alien insurer. D is correct because an alien insurer is one organized under the laws of a country other than the United States. The origin axis classifies insurers as domestic, foreign, or alien based on where they were organized. A is wrong because a domestic insurer is organized under the laws of California itself, not under the laws of a foreign country. B is wrong because a foreign insurer is organized under the laws of another United States state, whereas this insurer comes from another country entirely. C is wrong because fraternal describes a membership ownership structure organized under a lodge system, not the country in which an insurer is organized. Every insurer is classified by one simple question. In what jurisdiction was the company formed? That single axis, place of organization, drives how regulators admit and supervise companies doing business across borders. There are three positions on this axis. Domestic means organized under the laws of the state, chartered in California from California's view. Foreign means organized under the laws of another U.S. state like Nevada or Illinois. Alien means organized under the laws of another country entirely. Picture a company chartered in Europe opening operations in California. That company is alien. Its legal birthplace is outside the United States. The term does not describe what the company sells or how it is structured. It only fixes where the company was born. The key trap is mixing the origin axis with other descriptors. Domestic, foreign, and alien speak only to place of organization. Fraternal, by contrast, describes a membership society under a lodge system, a matter of ownership structure, not national origin. A fraternal could itself be domestic, foreign, or alien. When an exam stem names where a company was organized as the deciding fact, that is your signal. Apply the domestic, foreign, alien framework. Origin is the only thing these three terms measure. Question 21. A consumer purchases a health insurance policy to shift the financial consequences of a possible illness to an insurer. Which risk management technique does this represent? Your options are A. Risk avoidance, B. Risk transfer, C. Risk retention, D. Risk reduction. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is B. Risk transfer. B is correct because buying insurance is the classic example of risk transfer, because the financial consequence of a covered loss are shifted from the individual to the insurer for a premium. A is wrong because avoidance means eliminating the risk by not engaging in the activity at all, but the consumer cannot avoid the chance of illness this way. C is wrong because retention means keeping the risk and paying for any loss out of pocket, which is the opposite of buying coverage from an insurer. D is wrong because reduction lowers the chance or severity of a loss through loss control, while a policy instead pays for the loss after it occurs. Risk transfer is one of four classic ways to respond to risk. Rather than avoiding, reducing, or absorbing a loss yourself, You shift the financial consequence to someone else. In insurance, that someone else is the insurer. There are 4 classic responses to risk. Avoidance removes it entirely. Reduction lowers the chance or severity. Retention means paying any loss yourself. Transfer moves the financial burden onto another party. The mechanism is the insurance contract itself. The policy owner pays a small, certain premium, and in return the insurer accepts the uncertain, potentially catastrophic cost of a covered loss. When that loss occurs, the insurer indemnifies the insured according to the policy. The law of large numbers makes this work. By pooling thousands of similar risks, the insurer can predict total losses across the group, even though no one knows which individual will suffer a loss, making the unpredictable predictable. The examiner's nuance: buying a policy does not remove or reduce the chance of illness, and it is not retention because you are not paying the loss yourself. Risk transfer means the money consequence moves onto the insurer's books, leaving your exposure fixed and manageable. Question 22. Aside from reaching age 65, which of the following is a pathway to Medicare eligibility? Your options are: A. Earning a high income. B. Owning a small business. C. Receiving Social Security disability benefits. D. Holding an individual marketplace plan. Which would you go with? Lock it in before the reveal. The correct answer is C. Receiving Social Security disability benefits. C is correct because a person under 65 who has received Social Security disability benefits for the required period becomes entitled to Medicare. Other pathways include end-stage renal disease and amyotrophic lateral sclerosis. It is wrong because a high income does not create Medicare eligibility. Eligibility rests on age, disability, or specific diseases. B is wrong because owning a small business is unrelated to Medicare eligibility, which depends on age or qualifying disability. D is wrong because holding a marketplace plan is private coverage and does not by itself make a person eligible for Medicare. Medicare isn't only for people who've turned 65. The program has 3 distinct eligibility pathways, and understanding each one is key to distinguishing genuine roots from common misconceptions. The 3 doors into Medicare are reaching age 65, receiving Social Security disability benefits for the required 24 months, and being diagnosed with a specifically named disease. Income, business ownership, and private marketplace plans are not pathways at all. 2 diseases carry their own special rules: end-stage renal disease, permanent kidney failure requiring dialysis or a transplant, and amyotrophic lateral sclerosis, or ALS. Both open the door to Medicare. Notably, ALS skips the usual 24-month waiting period entirely. For the disability pathway, a person must have been receiving Social Security disability benefits for the required 24 months. After that waiting period, Medicare entitlement kicks in even if the person is decades away from 65, as long as the disability qualifies under Social Security's rules. When an exam question asks about an alternative route into Medicare, think of the 3 doors: age, Social Security disability after 24 months, and the named diseases. High income, self-employment, and private coverage do not qualify anyone for Medicare. Question 23. A long-term care policy must be at least guaranteed renewable, meaning the insurer may refuse to renew only for which reason? Your options are: A. The insured's declining health. B. Non-payment of premium. C. The insured reaching age 80. D. A change in the insured's occupation. Don't overthink it. Which one feels right? The correct answer is B. Non-payment of premium. B is correct because a guaranteed renewable long-term care policy cannot be cancelled for declining health. The only ground for non-renewal is non-payment of premium. The insurer may raise premiums for a whole class, but not for one insured. A is wrong because declining health cannot be a basis to refuse renewal of a guaranteed renewable policy. C is wrong because reaching a particular age is not a permitted basis to non-renew a guaranteed renewable long-term care policy. D is wrong because a change in occupation is not a ground for non-renewal. Only non-payment of premium ends the coverage. Guaranteed renewable long-term care policies carry a powerful promise. The insurer must keep your coverage in force. Understanding exactly what that promise covers and what the insurer can still do is the heart of this concept. The insurer has exactly one basis for refusing to renew: non-payment of premium. Declining health, advancing age, and changes in occupation are all explicitly prohibited grounds, because protecting against those very changes is the entire purpose of guaranteed renewability. The insurer must renew as long as premiums are paid. It cannot cancel or non-renew any individual policyholder for health or age reasons. It can raise premiums, but only across an entire class of similar policyholders, never targeting a single insured who has gotten sick. As long as the premium is paid, the door stays open, no matter how old the policyholder gets or how much their health has declined. The insurer's only lever is adjusting rates for an entire rating class, never singling out one person for getting sick. The policyholder controls the one thing that keeps a guaranteed renewable policy alive: paying the bill. Health declines, birthdays, and job changes are all irrelevant. As long as the premium is paid, coverage continues. Question 24. Under Medicare, the income-related monthly adjustment amount has what effects on certain beneficiaries? Your options are: A. It charges high-income beneficiaries a premium surcharge. B. It lowers premiums for low-income beneficiaries. C. It eliminates the Part B premium entirely. D. It applies only to hospital deductibles. Got a guess? Lock it in. The correct answer is A. It charges higher income beneficiaries a premium surcharge. A is correct because the income-related monthly adjustment amount adds a surcharge to the Part B and Part D premiums for higher income beneficiaries based on their modified adjusted gross income. Low-income beneficiaries pay only the standard premium. B is wrong because the adjustment raises premiums for higher earners. A separate low-income program, not this surcharge, helps low-income beneficiaries. C is wrong because the surcharge does not eliminate the Part B premium. It increases it for higher-income enrollees. D is wrong because the adjustment applies to Part B and Part D premiums, not to hospital deductibles. When Medicare beneficiaries earn above certain income thresholds, they pay more than the standard premium. This extra charge is called the Income-Related Monthly Adjustment Amount, or ERCA. IRMA applies specifically to Part B and Part D premiums. It adds a surcharge on top of the standard amount for higher earners. It never eliminates the standard premium, and it has no effect on Part A hospital deductibles or other cost sharing. The Social Security Administration uses your modified adjusted gross income from a prior tax year to place you in an income bracket. The surcharge climbs in steps at each higher tier, and it's recalculated as your income data updates, so you can move into or out of IRMA over time. It's equally important to know what IRMA does not do. It does not lower premiums for anyone. It does not erase the Part B premium, and it provides no help to low-income beneficiaries. Those individuals are served by entirely separate assistance programs. Think of IRMA as a surcharge aimed strictly upward. High earners pay more for Part B and Part D. The standard premium stays in place for everyone else, and hospital cost sharing is never touched. Question 25. Because the insurer alone drafts the wording of a policy, Any genuine ambiguity in that wording is generally interpreted in whose favor? Your options are A. The insurer that wrote it, B. The State Insurance Guarantee Fund, C. The insured or beneficiary, D. Neither party until a court rewrites it. Which one is it? Pause the video if you need more time. The correct answer is C. The insured or beneficiary. C is correct because an insurance policy is a contract of adhesion drafted entirely by the insurer. Because the insured cannot negotiate the wording, courts construe genuine ambiguities against the insurer and in favor of the insured. A is wrong because ruling for the insurer would reward the very party that created the unclear language, which the adhesion doctrine specifically refuses to do. B is wrong because the guarantee fund protects policyholders only when an admitted insurer becomes insolvent and plays no role in interpreting ambiguous wording. D is wrong because courts do not refuse to decide or rewrite the contract. They resolve the ambiguity in favor of the adhering party, the insured. Insurance policies are contracts of adhesion, drafted entirely by the insurer and handed to the applicant on a take-it-or-leave-it basis. The insured has no power to negotiate the wording, which creates a fundamental imbalance between the two parties. Because the insurer controls every word, the law responds with a protective rule. When policy language is genuinely ambiguous, courts construe that ambiguity against the insurer and in favor of the insured or beneficiary. The party that created the unclear language bears the consequence of it. The doctrine only operates on true ambiguity. If a provision can honestly be read two ways, the reading favoring coverage prevails. If the language is perfectly clear, courts enforce it exactly as written, even against the insured, because there is nothing to resolve. Picture the scale tipping toward the insured whenever the insurer's own wording is unclear. The insurer had every opportunity to write clearly and did not, so fairness places the risk of that murky language squarely on the drafting party. Remember the boundaries. Ambiguity runs against the insurer, never in its favor. Courts resolve the doubt. They do not rewrite the contract or invent coverage. And the State Guarantee Association is a separate mechanism entirely, dealing with insurer insolvency, not policy interpretation. Question 26. Under the Fair Claims Settlement Practices Regulations, when an insurer denies a claim in whole or in part, the denial must take which of the following forms? Your options are A. An oral explanation by phone is sufficient. B. No explanation is required. C. A note in the claim file. D. A written denial stating the specific reasons. Take a second. Which answer would you pick? The correct answer is D. A written denial stating the specific reasons. D is correct because the Fair Claim Settlement Practices Regulations require that a denial be in writing and state the specific reasons, including the policy provisions relied upon, so the claimant is not left guessing why a claim was denied. A is wrong because an oral explanation does not satisfy the regulation, which requires the denial to be communicated to the claimant in writing. B is wrong because the rules expressly require reasons for a denial, so providing no explanation would itself violate the Fair Claims standards. C is wrong because documenting the file internally is not enough. The claimant must receive a written denial that states the specific grounds for the decision. California's Fair Claims Settlement Practices Regulations set firm rules for how an insurer must handle a claim denial. When a claim is denied in whole or in part, the insurer must follow a specific form, and that form matters as much as the decision itself. A valid denial has two required elements. It must be in writing and it must state the specific reasons, including the exact policy provisions the insurer is relying on. Both are required. A written notice with no explanation, or a phone call with a thorough explanation, each falls short. Examiner's test, which form actually satisfies the rule. A written denial stating specific reasons is the only compliant form. An oral explanation over the phone does not qualify. Providing no explanation at all is an outright violation, and documenting the decision only in the insurer's internal file never reaches the claimant, so it fails too. The requirement is claimant facing. The written denial must travel from the insurer to the claimant, not stay buried in an adjuster's file. The claimant must receive on paper the specific factual and policy grounds for the refusal. The clean takeaway: a denial owes the claimant a paper trail with reasons. Writing plus specific grounds is the standard. Anything less, a call, silence, or an internal note, leaves the claimant in the dark, which is exactly what these regulations are designed to prevent. Question 27. Under a hospital income or hospital confinement indemnity policy, the flat daily benefit for each day of inpatient confinement is paid to which party? Your options are A. The attending physician, B. The hospital directly, C. The insured, D. A named beneficiary only. Before I reveal it, which one do you think is right? The correct answer is C. The insured. C is correct because a hospital income policy pays a fixed daily amount directly to the insured for each day of confinement. The benefit is unrelated to the actual bills and may be used for any purpose. A is wrong because the benefit is not paid to the attending physician. It is income paid to the insured to use however the insured chooses. B is wrong because the policy does not reimburse the hospital. It pays the insured a flat daily amount regardless of the hospital charges. D is wrong because the daily benefit goes to the insured during confinement, not to a beneficiary, who would receive proceeds only upon death. A hospital income policy, also called a hospital confinement indemnity policy, pays a fixed daily benefit for each day the insured is hospitalized as an inpatient. Understanding how this works means understanding three things: what the benefit is, what it's for, and who receives it. The benefit is a flat daily figure stated in the policy. It does not rise or fall with what the hospital charges. Its purpose is to cover the indirect costs a hospital stay creates: lost wages, family travel, childcare, and the deductibles or coinsurance your primary plan doesn't touch. The money flows directly to the insured, not to the hospital, not to the attending physician, and not to a named beneficiary. The hospital and physician are paid through other channels. The indemnity cash belongs to the insured to spend however they choose. Examiners love to test who receives the payment. The hospital is not reimbursed by this policy. The physician is paid through separate arrangements. A named beneficiary receives proceeds only upon death under a life insurance policy, a completely different product. The clean takeaway: a hospital income policy hands the insured cash per day of confinement, regardless of actual charges, with no strings attached. When a question asks who gets the fixed daily payment, the answer is always the insured. Question 28. Which of the following is not one of the standard activities of daily living used as a long-term care benefit trigger? Your options are A. Driving a car, B. Bathing, C. Transferring, D. Eating. What's your answer? Commit to one before I continue. The correct answer is A. Driving a car. A is correct because driving a car is not one of the 6 standard activities of daily living. The 6 are bathing, dressing, toileting, transferring, continence, and eating, all basic personal self-care tasks. B is wrong because bathing is one of the 6 standard activities of daily living, so it is not the exception. C is wrong because transferring, such as moving from a bed to a chair, is one of the 6 activities of daily living. D is wrong because eating is one of the 6 standard activities of daily living used as a benefit trigger. Long-term care policies use the inability to perform activities of daily living as the key trigger for benefits. Rather than relying on vague judgments, insurers tie eligibility to objective, observable self-care functions a licensed health practitioner can assess. The 6 standard activities are bathing, dressing, toileting, transferring, continence, and eating. Think of them as a morning routine of personal care. When a person cannot perform at least 2 of these 6 without assistance, the policy's benefit trigger is satisfied. Benefits can begin one of 2 ways: through the loss of a defined number of ADLs, or through a documented cognitive impairment such as advanced dementia. A person who is physically capable but requires supervision for safety due to cognitive decline also qualifies under the cognitive trigger. The critical distinction examiner's test is what belongs on the ADL list. Driving, shopping, cooking, managing money, and using the telephone are instrumental activities of daily living. They measure independent living skills, not basic personal care. Driving is never one of the 6 standard triggers. When an exam stem slips driving into a list of ADLs, that is the outlier. The 6 standard activities cover intimate personal care only. Any task beyond that morning self-care routine belongs to a different category entirely. Question 29. Which statement about combining a Medigap policy with a Medicare Advantage plan is correct? Your options are: A. Both work together to lower costs. B. Medigap replaces the Advantage plan automatically. C. Medigap pays the Advantage plan premium. D. Medigap cannot be sold with Advantage. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is D. Medigap cannot be sold with Advantage. D is correct because Medigap supplements original Medicare and does not coordinate with Medicare Advantage. It is illegal to sell a Medigap policy to a person enrolled in a Medicare Advantage plan because the supplement would pay nothing useful. A is wrong because the 2 do not work together. Medigap supplements original Medicare, while Medicare Advantage replaces how benefits are received. B is wrong because buying Medigap does not automatically replace an Advantage plan. The sale itself is prohibited. C is wrong because Medigap does not pay a Medicare Advantage plan premium. The products are not designed to interact. Medicare comes with 2 distinct paths for receiving your benefits, and understanding how they differ is the key to this rule. A supplement and a Medicare Advantage plan are not partners, they are alternatives. The first path keeps you in original Medicare, which you can pair with a Medigap supplement to fill its deductibles and co-insurance gaps. The second path enrolls you in the Medicare Advantage plan, a private plan that replaces how original Medicare delivers your care entirely. Medigap is built around the cost-sharing structure of original Medicare. Inside a Medicare Advantage plan, that structure is replaced by the plan's own network, co-payments, and rules, so a Medigap policy sold to an Advantage enrollee would pay little or nothing while still collecting premiums. The law turns this economic reality into a flat prohibition, because the supplement would pay nothing useful while the client remains in the Advantage plan. Selling one to an Advantage enrollee is not just inadvisable, it is illegal. A supplement and a Medicare Advantage plan are alternatives, not partners. They do not stack. The supplement does not pay an Advantage premium, and selling a Medigap policy to someone already in a Medicare Advantage plan is against the law. Question 30. Medigap plans C and F, which cover the Part B deductible, are close to which beneficiaries? Your options are everyone, since they were discontinued. B, those newly eligible in 2020 or later. C, people over age 70. D, anyone with Medicare Advantage. Which would you go with? Lock it in before the reveal. The correct answer is B, those newly eligible in 2020 or later. B is correct because Plan C and F, the only plans that cover the Part B deductible, are closed to people who became newly eligible for Medicare on or after January of 2020. Newly eligible beneficiaries instead buy the comparable plans D and G. A is wrong because plans C and F were not discontinued for everyone. People eligible before the cutoff may still have or buy them. C is wrong because eligibility for these plans turns on the Medicare eligibility date, not on reaching a particular age such as 70. D is wrong because the restriction is based on Medicare eligibility date. Separately, no Medigap plan may be sold to a Medicare Advantage enrollee. Plans C and F are unique among standardized Medigap supplements because they are the only plans that cover the Medicare Part B deductible. That single feature is at the heart of why access to these plans is now restricted for newer Medicare beneficiaries. Congress concluded that when a supplement pays the Part B deductible entirely, beneficiaries face no cost at the point of service, which can lead to overuse of care. So federal law discouraged this first dollar coverage, but only for newcomers, drawing the line at eligibility date rather than age. The rule is straightforward. Those who became eligible for Medicare before 2020 may keep or even purchase plans C and F. Those newly eligible on or after January 2020 are shut out of both plans entirely. Plan G mirrors Plan F in nearly every respect. The sole difference is that Plan G does not cover the Part B deductible. Similarly, Plan D parallels Plan C without that deductible coverage. Newcomers choosing between these pairs simply accept responsibility for that one deductible. Tie the closure to two things, the Part B deductible and the eligibility date. Age does not control it, and the separate ban on supplements for Medicare Advantage enrollees is an entirely different rule. Don't confuse the two. Question 31. A partial disability benefit is generally payable when the insured can do which of the following? Your options are A. Perform no duties at all. B. Perform only recreational activities. C. Perform some but not all job duties. D. Perform every duty fully. Don't overthink it. Which one feels right? The correct answer is C. Perform some but not all job duties. C is correct because a partial disability benefit is paid when the insured can perform some but not all of the duties of their occupation. It is commonly a flat 50% of the total benefit paid for a short period. A is wrong because an inability to perform any duties indicates total disability, not the partial disability the benefit addresses. B is wrong because the benefit turns on job duties, not recreational activities, which do not establish a partial disability claim. D is wrong because performing every duty fully means there is no disability, so no partial benefit would be payable. When a disability doesn't completely sideline someone, a partial disability benefit steps in. It covers the middle ground, when an insured can handle some of their occupational duties, but not all of them. Think of it as a spectrum. Performing no duties at all means total disability. Performing every duty fully means no benefit applies. Partial disability lives strictly in the middle, some but not all duties. The partial benefit is usually set at a flat share of the total disability benefit, commonly 50%, and paid for a capped number of months. It typically kicks in after a period of total disability, as the insured begins recovering and resumes part of the work. A related provision, the residual disability benefit, ties the payment to the actual percentage of income lost rather than a flat share. The key distinction is that the classic partial benefit always uses the flat share approach, not an income loss calculation. When a question describes an insured managing part of the job but not all of it, that's the partial disability benefit. The precise trigger, some but not all occupational duties, is exactly what examiners test. Question 32. Under the California Insurance Code, which of the following need a party not communicate to the other, even when directly asked about it? Your options are A. Information of the party's own judgment. B. A known material change in health. C. A fact the insurer specifically inquires about. D. The existence of other coverage. Got a guess? Lock it in. The correct answer is A. Information of the party's own judgment. A is correct because the California Insurance Code provides that neither party must communicate information of its own judgment, even upon inquiry. Facts must be disclosed if asked, but personal opinions need not be. B is wrong because a known material change in health is a fact that must be disclosed when material, so it is not protected from communication the way opinion is. C is wrong because a fact the insurer specifically inquires about must be answered truthfully. The exceptions for volunteering information end once a direct question is asked. D is wrong because the existence of other coverage is a fact that may be material and is not shielded from disclosure simply because it concerns the applicant. California's insurance code creates a duty of disclosure between parties to an insurance contract, but it also carves out a protected category, information of one's own judgment. Understanding where that line falls is the core of this principle. The code lists specific matters neither party is required to disclose. That last item, information of one's own judgment, is the one that specifically shields opinions, private estimates, and conclusions a party draws from the facts it holds. A party's judgment, a hunch about risk, a private estimate of value, sits on the protected side of that line, but a known material fact, like a health change or existing coverage, sits on the other side, and no protection shields it simply because it involves personal circumstances. The rule is clean in 3 parts. A party's opinion or judgment is its own. It need not be volunteered. Crucially, that protection holds even upon direct inquiry. But once the question is about a concrete fact, especially one that is material, the duty to disclose takes over. The easy way to remember this: separate opinion from fact. Judgment is protected even on request. Material facts, a health change, other coverage, anything the insurer directly asks about, must be answered honestly. The shield covers only the reasoning, never the facts beneath it. Question 33. Medicare Part A provides coverage for which of the following services? Your options are A. Routine eyeglasses and hearing aids. B. Outpatient prescription drugs. C. Physician office visits only. D. Inpatient hospital and skilled nursing care. Which one is it? Pause the video if you need more time. The correct answer is D. Inpatient hospital and skilled nursing care. D is correct because Part A covers inpatient hospital care, skilled nursing facility care, home health, and hospice. These institutional and skilled services are the hospital insurance half of original Medicare. A is wrong because routine eyeglasses and hearing aids are generally excluded from Medicare entirely, and they are not Part A benefits. B is wrong because outpatient prescription drugs are covered under Part D, not Part A. C is wrong because physician office visits are covered under Part B, the medical insurance part, not Part A. Medicare Part A is the hospital insurance foundation of original Medicare, the piece that protects beneficiaries from the crushing cost of serious, facility-based care. Understanding what it covers and what it doesn't is essential for sorting benefits correctly. Part A covers 4 core benefit categories: all on the institutional or skilled side of care. These are inpatient hospital care, skilled nursing facility care following a qualifying hospital stay, skilled home health care, and hospice care. Think of original Medicare as two halves that fit together. Part A handles the institutional side, admissions and facilities. Part B handles the outpatient and physician side. Prescription drugs fall under Part D, and routine eyeglasses and hearing aids are excluded from standard Medicare coverage altogether. When sorting benefits, inpatient hospital and skilled nursing facility care are Part A. Physician office visits belong to Part B. Outpatient prescription drugs fall under Part D. Routine vision and hearing aids sit outside Medicare's standard coverage entirely. The cleanest way to remember the split: Part A covers being admitted to a building, a hospital, skilled nursing facility, home health, or hospice. Part B covers the doctor and outpatient visit. When a question lists facility-based or skilled services, that's Part A. Question 34. A short-term disability policy is characterized by which of the following? Your options are A. Benefits payable to age 65. B. Short benefit and elimination periods. C. A long elimination period. D. Coverage only for death. Take a second. Which answer would you pick? The correct answer is B. Short benefits and elimination periods. B is correct because short-term disability pays for a short benefit period, often several months up to about 2 years, after a very short or zero elimination period. It covers the early gap right after a disability begins. A is wrong because benefits payable to age 65 describe long-term disability, not the shorter short-term coverage. C is wrong because short-term disability uses a short or zero elimination period, not a long one. D is wrong because short-term disability replaces income during a disability. It does not cover death like life insurance. Short-term disability insurance is built around two clocks: how fast it starts and how long it lasts. Understanding those two timers is the key to recognizing this product on any exam. Every short-term disability policy is defined by a short or even zero elimination period, meaning benefits begin almost immediately after disability starts, and a limited benefit period that commonly runs from a few weeks up to about 2 years. Visually, short-term disability fills the early gap right after a worker stops earning. Long-term disability picks up later, after a substantial elimination period, and can pay all the way to age 65. Examiners test the contrast carefully. A benefit period running to age 65 signals long-term disability. A long elimination period is the opposite of short-term coverage, and neither short-term nor long-term disability pays a death benefit. That belongs to life insurance. When a question describes coverage that begins almost immediately and lasts only a limited time, short-term disability is the answer. Short elimination period, short benefit period, and both clocks run fast. Question 35. A group plan in which the employer pays the entire premium and every eligible employee must be covered is known as which type of plan? Your options are A. A contributory plan, B. A blanket plan, C. A non-contributory plan, D. A self-funded plan. Before I reveal it, which one do you think is right? The correct answer is C. A non-contributory plan. C is correct because in a non-contributory plan, the employer pays the entire premium. So 100% of eligible employees must be covered. Because coverage is free to employees, full participation is achievable and required. A is wrong because a contributory plan has employees share the premium cost, and it requires only about 3/4 participation, not full coverage. B is wrong because a blanket plan covers a shifting class by description, not an employer-paid plan covering all eligible employees. D is wrong because a self-funded plan describes how claims are financed by the employer, not whether employees contribute to the premium. When it comes to group insurance, who pays the premium determines how many employees must be covered. Understanding this link is the core principle behind non-contributory and contributory plans. In a non-contributory plan, the employer pays the entire premium, and because coverage is free to employees, 100% of eligible workers must be enrolled. In a contributory plan, employees share the cost, so only about 75% are required to participate. The participation requirement exists to prevent adverse selection. If healthy employees could opt out, only the sickest would join, skewing the risk pool and driving premiums up. Requiring full enrollment keeps the pool representative and costs stable. The clean way to remember it: follow the money to the participation rule. When the employer foots the entire bill, every eligible employee is automatically covered. That is the defining pair of features for a non-contributory plan. Blanket and self-funded plans describe entirely different concepts, so do not confuse them here. When an exam stem says the employer pays the full premium and all eligible employees are covered, the answer is non-contributory. Question 36. Which of the following plans offers complete freedom of provider choice, requires no referral to see a specialist, and is not considered a managed care plan? Your options are A. Health maintenance organization, B. A traditional indemnity plan, C. A point of service plan, D. A preferred provider organization. What's your answer? Commit to one before I continue. The correct answer is B, a traditional indemnity plan. B is correct because a traditional indemnity or fee-for-service plan lets the insured use any provider and see specialists without a referral. It only finances care and is not a managed care plan. A is wrong because a health maintenance organization is a managed care plan with a network and a gatekeeper, the opposite of free provider choice. C is wrong because a point of service plan is a managed care plan that uses a gatekeeper for its in-network benefits. D is wrong because a preferred provider organization is a managed care plan that steers members to a network with discounted rates. The traditional indemnity plan, also called a fee-for-service plan, is the original model of private health insurance. Unlike modern managed care plans, it focuses purely on financing care rather than directing it. The indemnity plan has three defining freedoms. The insured can use any provider, see any specialist without a referral, and face no network steering whatsoever. The plan's only role is to reimburse covered expenses, often based on a usual, customary, and reasonable standard. The mechanism is straightforward. The patient selects any provider, receives care, and the plan pays its share afterward. There is no gatekeeper, no network penalty, and no referral hurdle, just reimbursement. The key examiner distinction is recognizing which plan sits outside managed care. The indemnity plan does. It only finances care. The HMO, PPO, and PS plans all manage care through networks, gatekeepers, or steering mechanisms. When a question describes coverage with complete provider freedom, no network, and no referral requirement, that is the traditional indemnity plan. It only pays, it never manages. Question 37. A health savings account is often described as offering a triple tax advantage. Which of the following best states that advantage? Your options are A. Deductible in tax-deferred growth, tax-free medical use. B. Taxable in taxable growth, tax-free out. C. No deduction, taxed growth, taxed withdrawals. D. Employer-only funding with no tax benefit. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. Deductible in tax-deferred growth, tax-free medical use. A is correct because a health savings account offers a triple tax advantage. Contributions are tax-deductible, earnings grow tax-deferred, and distributions are tax-free when used for qualified medical expenses. B is wrong because contributions to a health savings account are deductible rather than taxable going in, so describing them as taxable is incorrect. C is wrong because all three stages of a health savings account carry a tax benefit, so the claim that each is taxed contradicts the triple advantage. D is wrong because a health savings account may be funded by the individual and carry significant tax benefits, unlike an employer-only account with none. A health savings account is unique because it offers a tax benefit at not one, but three separate stages. Understanding how each stage works reveals why the HSA is one of the most powerful savings tools available for medical costs. The triple advantage means every dollar gets favorable treatment on the way in, while it grows, and on the way out. Contributions reduce your taxable income. Earnings accumulate without being taxed, and withdrawals for qualified medical expenses come out completely tax-free. Picture a single dollar walking through 3 doors, each one favorable. It enters as a deduction, grows sheltered from taxes inside the account, and exits tax-free when spent on qualified medical care. No other stage along the way triggers a tax event. The triple advantage only holds when withdrawals are used for qualified medical expenses. Non-medical withdrawals lose the benefit whilst they are taxed as ordinary income and before age 65, hit with an additional penalty. This is why the account rewards using it as intended. Most tax-favored accounts offer a break at 1 or 2 stages. The HSA stacks all 3, making it uniquely powerful for both near-term medical bills and long-term healthcare savings. Deductible contributions, tax-deferred growth, and tax-free qualified withdrawals. That is the accurate triple advantage description. Question 38. Under federal COBRA, an employee terminated for which reason is not entitled to elect continuation coverage. Your options are A. A company layoff, B. Voluntary resignation, C. Poor job performance, D. Gross misconduct. Which would you go with? Lock it in before the reveal. The correct answer is D. Gross misconduct. D is correct because an employee terminated for gross misconduct is not entitled to COBRA continuation. Ordinary terminations, such as layoffs, resignations, or performance-based discharges, are qualifying events that do allow continuation. A is wrong because a layoff is an ordinary termination that is a COBRA qualifying event, so the employee may elect continuation. B is wrong because voluntary resignation still allows COBRA continuation. Only termination for gross misconduct removes the right. C is wrong because being let go for poor performance is an ordinary termination that qualifies for COBRA, unlike gross misconduct. COBRA gives employees and their dependents the right to keep their group health coverage after leaving a job, but only when the reason for leaving qualifies under the law. A qualifying event is what unlocks continuation rights, layoffs, resignations, and reductions in hours that cost an employee coverage all count, because in each case, the law wants to prevent a sudden gap in health insurance. The dividing line is always the reason for separation. Every ordinary exit from a job is a qualifying event. Termination specifically for gross misconduct is the single exception that removes the continuation right entirely. Layoffs, resignations, and firings for poor performance all preserve COBRA rights. Only gross misconduct shuts the door. It is the one employment separation that is not a qualifying event under the law. The clean takeaway: almost every way of losing a job preserves continuation coverage. Gross misconduct is the single exception that destroys it. When an exam question asks who loses the right, the answer is always the employee dismissed for gross misconduct. Question 39. For life and disability insurance under California law, when must the insurable interest exist in order for the contract to be valid? Your options are A. Only at the time of loss. B. At the time the contract takes effect. C. Continuously throughout the policy term. D. Only when the claim is paid. Don't overthink it. Which one feels right? The correct answer is B. At the time the contract takes effect. B is correct because for life and disability insurance, insurable interest must exist when the contract takes effect. It need not still exist at the time of loss, unlike the rule for property insurance. A is wrong because requiring the interest only at the time of loss states the property insurance rule. Life and disability instead fix the interest at policy inception. C is wrong because continuous insurable interest is not demanded, because a valid life policy may continue even after the original financial interest has ended. D is wrong because tying the interest to the moment the claim is paid misstates the law. The decisive point is when coverage begins, not when proceeds are dispersed. Insurable interest is the legitimate stake a policy owner must have in the insured. So, the connection that makes a potential loss a real loss, not a wager. California law sets a specific timing rule for when that interest must exist. For life and disability insurance, insurable interest must exist at the time the contract takes effect, its inception. Property insurance is the opposite. Interest is required at the time of loss. For life and disability, the interest does not need to persist continuously after the policy is issued. Imagine two business partners who insure each other's lives when the firm is active. Insurable interest clearly exists at policy inception. Years later, the partnership dissolves, but the policies remain fully valid. The law only required the interest when coverage began, not that it lasts forever. Insurable interest can arise from close family ties and natural affection, or from a financial relationship such as a creditor, a business partner, or a key employee. Any of these connections, present at the time the contract takes effect, satisfies the requirement under California law. The clean takeaway is to anchor life and disability insurance at the start of the contract and property insurance at the moment of loss. When an exam question asks when insurable interest must exist for a life or disability policy, the answer is always when coverage begins. Question 40. Under original Medicare, who usually submits the claim for covered services? Your options are A. The beneficiary alone. B. The state insurance department. C. The provider or supplier. D. A Medigap insurer. Got a guess? Lock it in. The correct answer is C. The provider or supplier. C is correct because under original Medicare, providers and suppliers submit claims directly to the Medicare administrative contractor that processes claims for the region. The beneficiary generally does not have to file the claim. A is wrong because the beneficiary usually does not file the claim. The provider submits it, except in limited situations with non-participating providers. B is wrong because the state insurance department regulates insurers and does not submit Medicare claims. D is wrong because a Medigap insurer pays his share after Medicare, but it does not submit the original Medicare claim. Under original Medicare, the responsibility for submitting claims doesn't fall on the patient. Instead, the provider or supplier handles all the billing paperwork directly with Medicare. After a covered service, the provider submits the claim to the regional Medicare administrative contractor. A private company that processes Medicare claims for that geographic area. Medicare then determines and pays its share. The beneficiary stands largely outside the paperwork loop. The claim travels from the provider to the regional contractor. Medicare pays its share, and only then does a Medicare supplement, if the beneficiary has one, pay its portion through an automatic crossover. It helps to keep each party's role distinct. The provider submits, the MAC processes, Medicare pays its share, and a supplement pays afterward. The state insurance department regulates insurers but has no role in billing, and the beneficiary almost never files anything at all. When an exam question asks who submits claims under original Medicare, the answer is the provider or supplier, not the beneficiary, not the state, and not the supplement insurer. Question 41. A disability policy provides that the insurer cannot cancel and must renew to a stated age, but may raise premiums for an entire class of insureds. This describes which provision? Your options are A. Guaranteed renewable, B. Non-cancelable, C. Cancelable, D. Optionally renewable. Which one is it? Pause the video if you need more time. The correct answer is A. Guaranteed renewable. A is correct because a guaranteed renewable policy requires the insurer to renew as long as premiums are paid, but it allows the insurer to raise premiums for an entire class, never for one insured alone. B is wrong because a non-cancelable policy must renew and also locks the premium, so the ability to raise rates by class rules out non-cancelable. C is wrong because a cancelable policy can be ended at any time, which contradicts a provision that forbids cancellation and requires renewal. D is wrong because an optionally renewable policy lets the insurer refuse renewal for any reason, but here the insurer is required to renew. Guaranteed renewable disability income policies give the insured a powerful protection. The insurer must continue coverage up to a stated age, often 65, as long as premiums are paid. The insurer cannot cancel and cannot refuse renewal, but it does retain one important flexibility. The insurer is prohibited from cancelling, refusing renewal, or singling out one policyholder for a rate hike. The one power it retains is raising premiums, but only when applied evenly across an entire class of similar insureds. When claims experience or medical costs shift across a whole block of business, the insurer may reprice that class as a group. Every policyholder in the class sees the same adjustment. It is never a penalty aimed at one individual. 4 provisions rank by how much they bind the insurer. Cancelable binds at least. Optionally renewable lets it decline at renewal. Guaranteed renewable forces renewal but permits class-wide rate changes. Non-cancelable forces renewal and also freezes the premium entirely. The exam tests one line. The moment a policy allows class-wide premium increases, it is guaranteed renewable, not non-cancelable. Non-cancelable locks both the renewal right and the rate. Guaranteed renewable locks only the renewal right. Question 42. Under California's Medigap birthday rule, an existing policyholder has an annual window tied to their birthday to switch to another Medigap plan with which feature without medical underwriting. Your options are A. Richer benefits at no extra cost, B. Any plan from any insurer, C. A Medicare Advantage plan instead, D. Benefits equal to or less than current. Take a second. Which answer would you pick? The correct answer is D. Benefits equal to or less than current. D is correct because California's birthday rule gives an existing Medigap policyholder an annual window, starting on their birthday, to switch to a Medigap plan offering benefits equal to or lesser than the current coverage, without medical underwriting. A is wrong because the rule allows switching to an equal or lesser plan, not to richer benefits without underwriting. B is wrong because the switch is limited to an equal or lesser benefit plan. It is not an unrestricted right to buy any plan. C is wrong because the birthday rule concerns switching between Medigap plans, not moving into a Medicare Advantage plan. California's Medigap birthday rule is a consumer protection built specifically for people who already own a Medicare supplement. It creates an annual guaranteed window to switch plans without facing medical underwriting. Each year, beginning on the policyholder's birthday, a window opens, allowing them to move to a Medigap plan with benefits equal to or lower than their current coverage. Any insurer offering that plan must accept them on a guaranteed issue basis. No health questions, no denials. The critical limitation is the direction of the switch. A lateral move to equal benefits or a downward move to lesser benefits is fully protected, but an upgrade to richer benefits is not covered. That move would still require medical underwriting. Think of it as a one-way gate that opens sideways or downward, never upward. The rule protects the move to save money on comparable or simpler coverage, shielding policyholders from being trapped by their health when a cheaper equal plan is available. The cleanest way to remember this rule: it lets a supplement holder move sideways to equal coverage or down to lesser coverage, never up to richer benefits without underwriting, and it has nothing to do with switching into Medicare Advantage. Question 43. A method of setting a large group's premium based on that group's own prior claims experience is known as which of the following? Your options are A. Community rating, B. Experience rating, C. Manual rating only, D. Capitation rating. Before I reveal it, which one do you think is right? The correct answer is B. Experience rating. B is correct because experience rating sets a group's premium on its own prior claims history. The larger and more similar the group, the more reliably its past predicts its future, so it is used for large groups. A is wrong because community rating charges the same rate structure to all subscribers, regardless of any one group's loss history, the opposite of using a group's own experience. C is wrong because manual rating uses standard tables for a class rather than a particular group's actual claims experience. D is wrong because capitation is a per-member payment method used to pay providers, not a method of setting a group's premium. Experience rating is the method insurers use to set a group's health insurance premium, based on that group's own past claims history. The better the group's track record, the lower the rate they earn at renewal. The insurer examines the group's claims over a defined look-back period, compares actual costs to what was expected, and adjusts the premium up or down accordingly. Large groups produce credible data, making this analysis statistically reliable. It helps to contrast experience rating with the other methods. Community rating charges the same structure to all groups regardless of their individual history. Manual rating uses standard class tables rather than a specific group's claims. Capitation is a fixed per-member payment to providers. It sets provider pay, not group premiums. When an exam stem describes setting a large group's premium from that group's own historical losses, experience rating is the answer. The signal phrases are the group's own prior claims, credible data from a large group, and a price that directly reflects demonstrated experience. The simplest way to keep the method straight is to ask what the premium is built on. Only experience rating prices a group on its own record, giving the group a direct financial reason to support wellness and manage costs. Question 44. An assisted living facility is most appropriate for a person who fits which description? Your options are A. Requires intensive hospital treatment, B. Is terminally ill and needs comfort care, C. Needs only daytime supervision, D. Needs some help but is fairly independent. What's your answer? Commit to one before I continue. The correct answer is D. Needs some help but is fairly independent. D is correct because an assisted living facility serves people who need some help with personal care, meals, and housing, but remain fairly independent, more so than those who need full custodial nursing home care. A is wrong because intensive hospital treatment is acute care, not the residential support of assisted living. B is wrong because comfort care for the terminally ill is hospice, not the assisted living setting. C is wrong because needing only daytime supervision points to adult daycare, while assisted living provides a residence. Assisted living is a residential care setting designed for people who need some help with daily tasks, but remain fairly independent. It fills a crucial middle ground on the long-term care continuum. Think of care settings arranged by intensity. Adult daycare offers daytime supervision only. Assisted living provides a residence with help for daily tasks. A nursing home delivers full-skilled custodial care around the clock. Hospitals and hospice address acute treatment and terminal comfort care respectively. Staff assist residents with personal care, meals, housekeeping, and medication reminders. Crucially, this is supportive rather than medical intensive. Residents keep a fair degree of autonomy, coming and going and handling much of daily life on their own terms. Examiners test whether you can match the right setting to the right level of need. Assisted living fits someone who needs some help but remains fairly independent, not a person needing acute hospital care, terminal hospice comfort, or daytime-only supervision. When a question describes someone who struggles with a few daily tasks, yet manages much of life independently, assisted living is the answer. It bridges the gap between living entirely alone and requiring full nursing home care. Question 45. An insurer finds that mostly unhealthy individuals are applying for and renewing its new health plan, while healthier people decline it. This tendency is known as which of the following? Your options are A. Adverse selection, B. Profitable distribution of exposures, C. Coinsurance, D. Reinsurance. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. Adverse selection. A is correct because adverse selection is the tendency of higher than average risks to seek and keep coverage more than average risks do. It threatens an insurer because actual losses then exceed predictions. B is wrong because a profitable distribution of exposures is the balanced spread of risks good underwriting achieves, which is the opposite of what is happening here. C is wrong because coinsurance is a cost-sharing provision splitting covered expenses between insurer and insured, unrelated to which applicants choose to buy coverage. D is wrong because reinsurance is insurance an insurer buys to limit its own exposure, not the pattern of unfavorable risk crowding into a plan. Adverse selection describes a fundamental imbalance that can destabilize any insurance pool. Understanding means understanding why the mix of people inside a plan matters just as much as the premiums charged. The mechanism is straightforward. People who expect to file claims place a high value on coverage and hold on to it, while healthier people sense little need and drift away. The pool is left tilted toward high-cost members, so actual losses routinely exceed the insurer's original predictions. This self-reinforcing cycle is what makes adverse selection dangerous. As claims exceed expectations, the insurer raises premiums, which pushes the healthiest members out, making the remaining pool even sicker and driving premiums higher still. Examiners test whether you can separate adverse selection from three terms that sound related but mean something different. A profitable distribution of exposures is the balance pool that good underwriting aims to achieve. Sweet. The opposite of adverse selection. Coinsurance is cost sharing between insurer and insured, and reinsurance is coverage the insurer itself buys to cap its own exposure. Neither coinsurance nor reinsurance describes which applicants flock to a plan. When a question stem describes unhealthy risks gravitating toward a plan, while good risks stay away, that is adverse selection, when it describes a balanced, well-spread mix of risks, that is a profitable distribution of exposures. The goal underwriting and plan design exists to protect. Question 46. When soliciting long-term care insurance, a California agent must provide a senior prospect with which of the following? Your options are A. A free Medicare Advantage plan. B. A guaranteed benefit illustration. C. Notice of free high cap counseling. D. A cash gift. Which would you go with? Lock it in before the reveal. The correct answer is C. Notice of free high cap counseling. C is correct because at the time of solicitation, the agent must give the prospect written notice that the health insurance counseling and advocacy program provides free counseling, along with the long-term care shopper's guide from the Department of Aging. A is wrong because the agent must provide consumer information, not a free Medicare Advantage plan, which is unrelated. B is wrong because a guaranteed benefit illustration is not the required disclosure. The high cap notice and shopper's guide are. D is wrong because offering a cash gift to induce a sale is improper, not a required consumer disclosure. When an agent in California solicits long-term care insurance from a senior, the law requires specific consumer protections to be delivered right at the point of solicitation, before any sale is closed. The agent must hand the prospect two specific items: a written notice that the health insurance counseling and advocacy program offers free counseling, and the long-term care shopper's guide published by the California Department of Aging. The rule exists because long-term care decisions are complex and seniors can face pressure. Lawmakers wanted buyers to have access to independent, unbiased help, not just the word of someone motivated to make a sale. At the moment of solicitation, the agent hands over these two materials. They point the senior toward resources outside the transaction, where questions about coverage, alternatives, and suitability can be answered without a sales motive attached. Remember, the mandated items are the counseling notice and the shopper's guide. A benefit illustration is not the required disclosure, and a cash gift is not a consumer protection at all. It's an improper inducement the law forbids. Question 47. An indemnity plan pays a provider's full charge as long as it matches what other providers in the same area charge for the service. This payment method is known as which of the following? Your options are A. Capitation, B. A benefit schedule, C. A corridor deductible, D. Usual, customary, and reasonable. Don't overthink it. Which one feels right? The correct answer is D. Usual, customary, and reasonable. D is correct because the usual, customary, and reasonable method pays the full charge if it is consistent with what other providers in the same geographic area charge. Charges above that level may be billed to the patient. A is wrong because capitation pays a provider a flat monthly amount per member, not the prevailing charge for each individual service. B is wrong because a benefit schedule lists a fixed dollar amount per service in advance, so it does not pay the full prevailing local charge. C is wrong because a corridor deductible bridges a basic and a supplemental plan. It is a deductible, not a method for setting provider payment. The usual, customary, and reasonable method, UCA, is how indemnity plans decide what portion of a provider's charge to cover. It ties payment to what providers in the same geographic area typically charge for the same service. When a charge falls within the prevailing local range, the plan pays it in full. When a charge climbs above that range, the plan pays only up to the UCR level, and nara wakin fade. The remaining difference becomes the patient's responsibility, a concept called balance billing. UCR exists because indemnity plans let patients choose any provider. Without a local ceiling, plans would have no defense against inflated charges. By benchmarking against local norms, the plan pays fairly while protecting itself and the entire risk pool. The key exam skill is separating UCR from other arrangements. Capitation pays a flat monthly amount per member, regardless of services. A benefit schedule pays a fixed preset dollar figure per service. A corridor deductible bridges two layers of coverage. It is not a provider payment method at all. When an exam stem describes a plan paying a charge because it is consistent with what other providers in the area charge. That is the usual, customary, and reasonable method. Match the phrase to the concept and you will not confuse it with the others. Question 48. Under the California Insurance Code, insurance is a contract in which one party agrees to indemnify another against loss, damage, or liability arising from which kind of event? Your options are A contingent or unknown event, B, a certain and scheduled event, C, an event producing a guaranteed gain, D, a past event known to both parties. Got a guess? Lock it in. The correct answer is A, a contingent or unknown event. A is correct because the California Insurance Code defines insurance as a contract to indemnify another against loss from a contingent or unknown event, so the trigger must be uncertain in whether or when it happens. B is wrong because a certain scheduled event carries no uncertainty, and without uncertainty there is no risk for an insurer to assume. C is wrong because the chance of a guaranteed gain describes speculative risk, which insurance never covers. Insurance restores a loss rather than creating profit. D is wrong because an event already known to both parties is no longer contingent or unknown, leaving nothing uncertain to insure under the statute. The California Insurance Code defines insurance as a contract to indemnify against loss arising from a contingent or unknown event. That phrase, contingent or unknown, is the heart of the entire definition. An insurable event must be uncertain in one of two ways, either uncertain to happen at all or uncertain as to when it will happen. Events that are already certain, already past, or scheduled on a fixed date carry no real uncertainty and fall outside the definition entirely. Insurance works by pooling many people who each face the same uncertain possibility of loss. When the outcome is genuinely unknown, the insurer can spread the cost of actual losses across the whole group. If the outcome was certain, there would be no risk to pool, just a known expense being funded directly. Insurance covers only fortuitous events, ones that depend on chance. The payout indemnifies, meaning it restores the insured to their prior position rather than producing a profit. A guaranteed gain or a speculative profit motive takes an arrangement completely outside the definition of insurance. When you see a question asking what kind of event insurance must be built around, the answer is always a contingent or unknown event. No real uncertainty means no insurable risk, and any payout must restore a loss, never create a windfall. Question 49. When the children of married parents are covered under two group plans, the birthday rule designates which parent's plan as primary. Your options are A, the plan of the older parent, B, the plan of the higher earner, C, the parent with the earliest birthday, D, the plan with the lower deductible. Which one is it? Pause the video if you need more time. The correct answer is C, the parent with the earliest birthday. C is correct because under the birthday rule for coordination of benefits, the primary plan for the children is that of the parent whose birthday falls earliest in the calendar year, by month and day, not the older parent. A is wrong because the rule uses the earliest birthday in the year, not which parent is older. So age is not the deciding factor. B is wrong because the higher earners plan is not the basis for the birthday rule, which looks only at the earliest calendar birthday. D is wrong because the deductible amount does not determine primacy under the birthday rule. The earliest birthday in the year controls. When a child is covered under both parents' group health plans, coordination of benefits steps in to decide which plan pays first. The tool it uses is called the birthday rule. Coordination of benefits ensures that two overlapping plans never together pay more than the actual cost of care. One plan is designated primary, paying first, while the other is secondary, picking up what remains. The birthday rule compares only the month and day of each parent's birthday. The parent whose birthday falls earlier in the calendar year holds the primary plan for the children. The birth year, and therefore which parent is older, is completely ignored. Three things the birthday rule never considers: which parent is older, which parent earns more, and which plan has richer benefits or a lower deductible. Only the earliest month and day in the calendar year determines primacy. The clean takeaway is month and day, not year, not money. Whichever parent's birthday comes earliest in the calendar year has the primary plan for the dependent children. Do not confuse this with California's Medigap birthday rule. That is an entirely separate provision. Question 50. A subscriber suffers a medical emergency while traveling outside the HMO service area and is treated by a non-network provider. How does the HMO generally handle this? Your options are: A. It denies all out-of-area care. B. It reimburses the emergency care. C. It pays only after a specialist referral. D. It converts the member to a PPO. Take a second. Which answer would you pick? The correct answer is B. It reimburses the emergency care. B is correct because emergencies are the exception to the network-only rule. An HMO must reimburse a subscriber for emergency care obtained outside the service area from a non-network provider. A is wrong because the HMO does not deny all out-of-area care, because genuine emergencies are reimbursed even when received outside the network. C is wrong because an emergency requires immediate treatment, so the plan does not condition payment on first obtaining a specialist referral. D is wrong because experiencing an emergency does not change the member's plan type. The HMO simply reimburses the out-of-area emergency care. Health maintenance organizations are built around network-only care, but there is one firm exception: genuine medical emergencies outside the service area. Understanding why this exception exists helps clarify how HMO coverage actually works. The exception exists because emergencies are inherently unschedulable. A member cannot choose to have a heart attack only near a network hospital. Forcing network compliance during a crisis would defeat the entire purpose of having coverage. So the law requires reimbursement. When a subscriber is treated at a non-network hospital during a genuine emergency, the HMO must reimburse that care. No referral is needed and no network hospital search is required. The emergency itself triggers coverage. Examiners test the nuance carefully. The HMO does not deny all out-of-area care, does not require a specialist referral before treatment, does not convert the member to a different plan type, and does not demand a network facility. It simply reimburses the emergency. The clean takeaway: the network rule exists to manage routine care, not to abandon members in crisis. Out-of-area emergency care is covered wherever it happens, with no referral required and no plan change. The emergency is simply reimbursed.
You have reached the end of our first question set. For the free complete exam preparation, visit our website, link in the description, where you find thousands more practice questions and comprehensive study guides. Thanks for studying with us today. See you in the next video.